All right, let's talk about the two companies you've probably never heard of, but that literally design everything. You know, all the big names, right? NVIDIA, Intel, AMD. Well, today we're pulling back the curtain on Cadence and Synopsys, the hidden giants, the true architects who build the tools that make every single one of those modern chips possible. Let me start with a question for you. What if just two companies, and only two, controlled the software blueprints for basically every piece of tech you touch? I'm talking about your smartphone, the servers powering the cloud, your car, those massive AI clusters, everything. It sounds like something out of a sci-fi movie, but you know what? It's way closer to reality than you might think.
Well, that's where Cadence and Synopsys come in. They are the answer. Together, these two form an incredible duopoly, with a stranglehold on somewhere between 70 and 85% of the entire electronic design automation market. That's the EDA market. But they don't go about it in the same way. Cadence is what we'll call the system and efficiency play, focusing on pure high-end software. And Synopsys? They're the scale and IP play, acting like a giant supermarket of building blocks for chip designers.
Okay, let's really get into this unseen chip duopoly. While all the headlines and all the buzz are about NVIDIA's next big GPU, Cadence and Synopsys are the classic picks and shovels companies in this gold rush. They aren't digging for gold, they're selling the tools to every single miner. And for any investor looking at this space, that is a fundamentally important and powerful place to be.
So what makes them so powerful? Well, the foundation for both businesses is identical and it's beautiful. They both run on a super predictable recurring revenue model. It's essentially a subscription model on steroids. Think about it. A company like Apple or Samsung can't just decide to cancel their subscription. Their entire multi-billion-dollar R&D pipeline would grind to a halt overnight. That creates an incredibly sticky and reliable stream of cash flow.
So, with that shared, stable foundation, how do they actually compete with each other? This right here is where it gets really fascinating. Let's break down their divergent business models, because their paths to dominating this market are fundamentally different.
First up, let's talk about their approach to intellectual property, or IP. The best way to think about IP is like pre-made Lego blocks for chip designers. Synopsys has a really aggressive strategy here. They're like the Costco of chip design. They have a massive catalog of standard, essential blocks like USB controllers. This approach drives huge revenue. Cadence, on the other hand, is much more selective. They're like a boutique, focusing on high-performance, custom-built IP for very specific, very profitable markets, like advanced data centers.
In this diagram, this brilliantly illustrates their technical moat, and it is deep. The chip design process has a few key stages. Cadence is the undisputed king of that first stage, analog design. Their Virtuoso tool isn't just dominant, it's practically a monopoly. Now, the middle stages are a battleground, but that final, absolutely critical stage, sign-off, that belongs to Synopsys. Their prime-time tool is known as the golden ruler. It doesn't matter whose tools you use to design your chip. At the end of the day, it has to get the final stamp of approval from prime-time before you can send it to the factory. That is a ridiculously powerful position to be in.
All right, so we've got the strategy. We see the moats. Now, how does all this shake out on the balance sheet? Let's get to the cold, hard numbers in the financial showdown.
And right out of the gate, you see the power of Synopsys' scale-it-up strategy. They're pulling in about $2 billion more in revenue. That is not small change. It's a direct result of having that massive IP portfolio and just a broader customer reach, which brings in more top-line cash year in and year out.
But you know, revenue is only part of the story. You have to look at the margins. Cadence, with this laser focus on high-value software, has an incredible gross margin of nearly 90%. That is just elite software company territory. Synopsys is lower because selling those IP Lego blocks has higher costs. But then look at the net margin for 2024. Synopsys made a huge jump to almost 37%. How? They smartly sold off a less profitable part of their business to double down on their core, highly profitable EDA and IP units.
Okay, so what about efficiency? How good are they at turning $1 into more dollars? That's really what we're asking with these metrics. And when you look at return on invested capital, or ROIC, I mean, it is a dead heat. It's practically a photo finish. Both are generating phenomenal returns around 67–68%, which tells you they are just absolute machines at allocating capital. On return on equity, Cadence has a slight lead, showing it can squeeze just a little bit more profit out of its leaner asset base.
Now this is a fascinating slide. Even though Synopsys has that $2 billion revenue lead, their free cash flow, the actual cash they're generating, is almost identical to Cadence's, right around $1.25 billion. That just screams incredible efficiency on Cadence's part. But the other big story here is cash. Look at that. Synopsys is sitting on a $4 billion war chest. That gives them a ton of firepower for big acquisitions or just to ride out any storm.
So where's all that money going? Well, they're feeding the beast. Both of them plow more than a third of their revenue right back into research and development. They have to. It's how they keep that technical moat wide and deep. Now, what about you, the shareholder? Right now, neither pays a dividend. These are growth stories, pure and simple. Cadence has been more active with stock buybacks recently, but both are clearly focused on reinvesting for growth.
So, we've got these two financial juggernauts, incredible businesses. But for you and me, the question is always the same. What's the price of admission? Let's talk performance versus price.
Looking back 5 years, both stocks have absolutely crushed the market, but Cadence has been the bigger winner, a real rocket ship delivering a 138% return. It's a bit more volatile, tracking closer to the high-flying semiconductor index. Synopsys, on the other hand, has delivered its incredible returns in a more stable, steady-eddy kind of way.
That's great for anyone who got in 5 years ago, right? But for us, looking to invest today, it leads to the single most important question you have to ask. Are you overpaying for that awesome performance?
And when you look at Cadence, the answer might be yes. It's trading at a price-to-earnings ratio of over 82. Let me be clear. That is a very, very rich valuation. The market is basically expecting them to be perfect. It's pricing in perfection, and there is zero room for error at this price.
Now, let's contrast that with Synopsys, sitting at a PE of 63. Now, don't get me wrong, that's still a premium price tag by any normal standard, but it represents a nearly 25% discount to its only real rival. For any value-conscious investor, that's a pretty big difference. Okay, let's pull this all together. Time to land the plane and give the final analyst's verdict on which of these titans might be the right fit for your portfolio.
But before we do that, we have to talk risk. No investment is a sure thing, and these are no different. They both face customer concentration risk. I mean, if Apple or Nvidia sneezes, they could catch a cold. Geopolitics and export controls are a constant headline threat, and as we just saw, with valuations this high, they are both at risk of compression if growth slows down even a little bit.
So here it is, the final tale of the tape. It's a real clash of the titans, isn't it? Synopsys takes the crown for sheer size and that improved net margin. Cadence wins on that beautiful gross margin and pure efficiency. On ROIC and free cash flow, it's a dead heat. Synopsys has the cash advantage, Cadence carries the higher price tag.
So, what's the final call? Well, honestly, it really comes down to your personal investing style. Are you a go-for-growth, pay-the-premium kind of investor? Cadence, with its higher momentum and pure software focus, is probably your play. Or are you more of a value and stability type? Well, then you're likely leaning towards Synopsys, with its golden ruler moat, its massive war chest, and that more attractive valuation.
But that leads us to one final, really interesting thought. Maybe the question isn't which one should I choose, maybe the right question is why choose at all? As this final analyst note suggests, the duopoly basket strategy, just owning both, has historically been the smartest way to get risk-adjusted exposure to this entire critical ecosystem. It stops being a bet on a single company and becomes a bet on the continued advancement of technology itself. And that's a pretty compelling idea to leave you with.